Welcome students. Welcome to the welcome to the session, online mentoring session of Paper-8 Indirect Tax Laws on Foreign Trade Policy. I am CA Shefali Jain.
I am CA Smita Mishra.
We both are your mentors for today's session.
As you know that today's session is a continued session. It is in continuation of the last session which we had on foreign trade policy on 9th of February. So we'll be covering the topics which we were not able to complete that day. So just before you start with the session, just a quick recap of what all we covered on 9th. We covered basically first what is the concept of foreign trade policy, how is it administered by DGFT, then what are the various contents of the policy like foreign trade policy, procedures, SIN and ITCHS, etc., etc. Then what are the underlined objectives on the basis of which the policy has been framed this time, before foreign trade policy 2015-2020. Then the various export promotion policies which are covered under the foreign trade policy. In the last session, we covered advance authorization, DFIA, EPCG, and the duty credit scripts. And the remaining portion, which is in your syllabus, we'll be covering those things in today's session.
So let us move to the PowerPoint presentation. Students may note the disclaimer statement. Students are advised to refer to the study material, including supplementary study material if any, and other relevant legislation for latest provisions or amendments required for the forthcoming examination. Now let us start with the next scheme, export promotional scheme, that is EOU scheme. EOU stands for Export Oriented Unit. Now what does it actually mean? Export Oriented Unit is a unit which can import inputs and capital goods without payment of duty. And similarly, now this is for import, they can also procure the inputs and capital goods without payment of excise duty. That means it is an indigenous procurement. They are procuring these goods indigenously. And in return, what these units have to do is they must export their entire production. That is why we sometimes call them 100% EOU. So they have to export 100% of their production outside India. Okay, production of goods or provision of services, whichever is the case. But there is a exception clause also here, that is in certain cases they may make sales in DTA. First of all, what is DTA? DTA stands for Domestic Tariff Area. Now EOU units, although they are expected to sell entire production outside India, they are expected to export their production, but in certain cases they are allowed to sell this output, sell their production within India also. And this sale is known as DTA sale, that is Domestic Tariff Area. DTA, that means within India they are selling these goods. So this is called DTA sale. So there is a permissible limit up to which they can sell the goods in DTA also. Certain conditions also need to be fulfilled. So the overall concept of EOU is that EOU are required to export all their output, their production of goods and services. And in return, they will get the import of inputs and capital goods duty-free. Similarly, they can procure the inputs and capital goods domestically also, and that will also be without payment of any excise duty. Now, EOU is actually, it can be set up at various places in India. Certain notified places are there. In fact, across India, there are around 350 places where you can establish your export-oriented unit. These places are notified. And these places are notified as warehousing stations because EOU is considered as a bonded warehouse. Okay, so at these warehousing stations, you can establish your EOU, which is taken as a bonded warehouse. We'll deal with this bonded warehouse concept in next slide in more detail. But before that, you should know that export-oriented unit has one more benefit with it, attached with it, that it can export the restricted items also. Okay. but not prohibited. Prohibited items cannot be sold by it, but restricted items it can sell subject to certain conditions which are attached to it, but not prohibited items. Restricted items you can sell. And whenever you export any consignment, whenever you export any goods, you are required to get it sealed by the custom officers at your factory gate itself. But in case of EU, however, status holders have this facility that they can seal their export consignments themselves. Similar facility is available. Self-sealing of export consignments is permissible in case of UU also, even if such EOU is not a status holder. So this is also a special facility which is given to an EOU. Now I told you that EOU is a bonded warehouse. So what does I mean by that? EOU, when I say EOU is a bonded warehouse, it means that whole factory is treated, the premises of the whole factory of EOU, they are treated as a bonded warehouse. These premises have to be registered. You have not registered. EOU has to obtain a license as a bonded warehouse, as a private warehouse under customs law. Okay. Under section 58, private warehouse license is obtained under section 58 of the Customs Act. So EOU is a private warehouse, or you can say for establishment of EOU, you have to obtain a license under section 58 as a private warehouse. It should have a separate earmarked premises. Okay, its premises should be separately earmarked, and this license as a private warehouse shall be issued for 5 years at one time. But in case of a private warehouse, you are generally not free to manufacture any item within that private warehouse. But in case of EOU, the manufacture as well as clearances of raw materials or finished goods, it shall not be under supervision or control of custom authorities. This is a kind of leverage has been given to EOUs. Only thing is that proper records need to be maintained. EOU has to maintain proper records of its goods manufactured, goods cleared from the EOU. But again, bill of entry or duty payment is not required when goods are released for manufacture. When you are releasing your goods, your inputs, raw materials for manufacture, then in that case, no bill of entry, no duty payment is required within an EOU. So this is the concept of EOU being a bonded warehouse. In fact, when I started it, this scheme is not in fact limited to EOU. This scheme is also available to certain other units also, and that is STP, Software Technology Park, EHTP, Electronic Hardware Technology Park, and BTP, that is Biotechnology Park. So this scheme is actually a combination and integrated scheme for all these four: EOUs, Export Oriented Unit, STP, EHTP, and BTP. The only difference, more or less, you will find that these schemes are scheme for EOU, STP, EHTP, and BTP are more or less identical. Only thing is that EOU can be set up at warehousing stations, whereas the STP, EHTP, and BTP, they can be set up at the place where this is EOU, where EOU can be established, or at certain specified zones like SEZ, like the places where the special economic zones. So this EHTP, STP, and BTP, they can be set up either at the SEZ, special economic zones, or at the places where EOUs can be established. Second difference is the authority which administers EOU. So EOU is administered by the Ministry of Commerce, whereas the STP and EHTP, they are administered by the Ministry of IT, Information Technology, and BTP is administered by the Ministry of Biotechnology. Okay, so their administrating authorities are different, and the places where they can be set up, that has a minor difference between them. Now, what is the eligibility for EOU? Which type of units are eligible for EOU? The units which are set up for manufacture, so either it can be a manufacturing unit or a service unit, or engaged in development of software or agriculture. So for these four purposes, you can establish or you can set up an EOU unit. But trading units are not covered. So we are only covering the manufacturing units or service providing units, but for trading purposes, if you are establishing, you are exporting something, but that is your unit is a trading unit. It only purchases goods and sells it directly. Then that will not be allowed under EOU. Then third condition for eligibility is the minimum investment. minimum investment in plant and machinery of an EOU should be rupees 1 crore. Okay. Now, to this condition that minimum investment should be 1 crore, there are certain exceptions also. First of all, it shall not apply to any existing unit in EHTP, STP and EOU. Then EOU in handicraft, agriculture, floriculture, aquaculture, animal husbandry, information technology services, brass hardware and handmade jewelry sectors. In these EOUs, this minimum investment is not required. And moreover, in a board of approvals, if it wishes, it is an authority which approves this EOU establishment. So board of approvals, if it wishes, it can allow a lower limit also. Lower investment in plant and machinery. Then also you can establish an EOU if board of approval allows it. Now we come to the procedure for setting up a new EOU. The approval, first of all, there are two types of approvals. Automatic approval. In case you don't get the automatic approval, you have to get the approval by board of approvals, which we just discussed, that board of approval grants the approval in certain cases. Automatic approval requires certain conditions to be fulfilled. In case those conditions are fulfilled, then you will get the approval from units approval committee. That will be an automatic approval and that will be granted within 15 days. But you have to fulfill certain prescribed criteria, certain conditions. If those conditions for automatic approval are not satisfied, then in that case, board of approvals will grant the approval. This is just the procedural part. And after the approval is granted, then the letter of permission or letter of intent will be issued. Now this letter of permission or letter of intent is a kind of authorization which is granted to the EOU to start its operations. And within grant of this letter of permission or letter of intent, within 2 years, the production should start, because this letter of approval will have an initial validity of 2 years. So within these 2 years, once an EOU gets a letter of permission, that means it has got the permission to start its production. So it has to complete that production within 2 years. It has to start producing. It has to start the production within 2 years. It will first of all establish the plant and machinery. All other formalities will be done, and within 2 years it should start producing. And this period is extendable by again 2 years. And if any further extension is required, then that has to be done by board of approvals. So this is the procedure for setting up a new export-oriented unit. Now, one major condition which is attached with EOU is that EOU unit must be a positive NFE earner. NFE is net foreign exchange. So an EOU unit must have a positive NFE. What does that mean? Positive NFE means that its exports should be more than its imports. To be more precise, its FOB value of exports must be higher than CIF value of all imports of inputs and capital goods and value of all other payments. So exports should be more than imports. It should have a positive NFE. But what if positive NFE is not achieved? Then in that case, it has to pay duty and interest in proportion to default. Okay. In case of certain sectors, a higher value addition is required. That means just having a positive NFE will not suffice. Certain percentage has been prescribed and that should be achieved. Now, this NFE earning shall be calculated for a block of 5 years. It will be calculated cumulatively in block of 5 years, and this will start from the commencement of production. And who monitors this NFE? Unit Approval Committee. It monitors the NFE. Okay, now generally what type of supplies we take for computing or for counting the positive NFE? Any supplies which are made to holders of advance authorization, then DFIA or EPCG scheme, all these authorization holders, if any supplies have been made by EOU to these authorization holders, that will be counted in net foreign exchange earnings. Then the supplies to other export-oriented units, EHTP, STP, BTP, and in fact SEZ units also. Then supplies made to bonded warehouses and supply of LPG to public sector domestic oil companies will also be counted for NFE purposes. Now in case an EOU procures certain goods from DTA, that is, it procures certain goods domestically from domestic manufacturer. Then what is the benefit which DTA unit, or you can say the domestic manufacturer, will get? Domestic manufacturer will be entitled to the deemed export benefit. Okay, now deemed exports we'll discuss. This is the next export promotional measure which we'll discuss in detail, and this point we'll take later there in greater detail. But here, just to summarize, DTA unit will be entitled to benefit of deemed exports, and DTA unit is not, that means DTA unit is not required to pay excise duty on final products supplied to EOU. Further, it can utilize the, no excise duty, and it can take the SINVAT credit on inputs and services. Okay, so both the benefits are available, and in case the SINVAT credit remains unutilized, then it can claim the refund of the SINVAT credit also under Rule 5 of the CCR. Okay. However, this EOU will be eligible for the deemed export benefits on production of a suitable disclaimer from DTA supplier. Now, what are the benefits which EOU, EHTP or BTP they will get from for supplies from DTA? When the DTA unit supplies goods to EOU, then what benefits this EOU will, or EHTP, STP, BTP units will get? First one of which is reimbursement of central sales tax. So whenever a DTA, whenever a EOU or any other EOU unit or EHTP or whatever it is, it procures certain goods domestically, then the central sales tax paid on goods manufactured will be reimbursed. Okay, and in case it is not in case there is a delay in reimbursement of CST, then interest at the rate of 6% per annum will be payable. It has to, this reimbursement should be done within 30 days of receipt of complete application. So this is just a procedural part once again, that within 30 days this reimbursement should be received, and if not received within 30 days, then 6% per annum at this rate interest will be payable. Okay. Second is exemption from payment of central excise duty. Again, if any domestic supplier is providing goods to EOU units, then he will be exempted from payment of the central excise duty. And the next one is the reimbursement of duty paid on fuel procured domestically. So any fuel procured domestically from the domestic oil companies or depots of domestic oil public sector undertakings, then that duty will also be reimbursed as per drawback notified in this regard. Okay. And as regards the service tax, so we have seen central sales tax reimbursement will be given, central excise duty reimbursement will be given. But with regard to service tax, you will get the SINVAT credit. Okay, the benefit with regard to service tax paid on the services procured from the domestic service providers, you can take the SINVAT credit. So for them, the facility of non-payment or exemption from service tax is not available. They can only claim the SINVAT credit of the service tax paid on the services which are procured by an EOU from the DTA units. Then these were the major entitlements which are available to a EOU unit. Besides this, certain other entitlements are also there. That is, the units are exempted from industrial licensing for manufacture of items reserved. So the items which are reserved for manufacture of only SSI sector, for that if the EOU also wishes to manufacture them, they need not obtain the industrial licensing. Then export proceeds to be realized within 9 months. And further, the units have to pay duty on goods produced and cleared into DTA on monthly basis in the manner which is prescribed in central excise rules. You know that under central excise rules, the EOU provisions are contained. So those provisions are also applicable. Now, so broadly we covered that DTA units are, the EOU units are allowed to import anything without payment of duty or procure domestically. And similarly, they have to export all the products. Now, duty free, when I say duty free import, what does that include? All goods. They can import all goods, including capital goods, which are required for its activities, and These goods can either be imported, it can import it from outside India, or it can procure from DTA. That means from within India, from India it can procure from bonded warehouses in DTA or international exhibition held in India. But the main point here is that it should be all these imports. Imports, when I say imports, it includes capital goods also, and these imports shall be subject to actual user condition. Actual user condition, you know that the goods should be used by the person who has actually imported them. So actual user condition is applicable in case of the goods imported by EOU. It cannot transfer those goods before, Transfer is not allowed in this case. One more point is there, that when I say all goods, it still excludes prohibited goods. This point was covered by me earlier also. In the first slide itself, I told you that prohibited goods are strictly not allowed to be imported. Otherwise, all other goods it can import. Domestic import also, and it can procure domestically also. Then, besides this capital goods, when I say in EPCG, the second-hand capital goods were not allowed to be imported. But here, in case of EOU, this is a difference in case of EOU units. They are allowed to import second-hand capital goods also. Without any age limit, they can be imported. So this is also a benefit which is given to EOU units. And export promotion material. Any material which is used for export promotion, that is also allowed, but there is a limit to it. That is a 1.5% of FOB value of the previous years. When I come to exports, all kinds of goods and services, they are allowed to be exported. But again, on export also, the restriction of export of prohibited items is there. So prohibited items can neither be imported nor be exported. And besides that, these comet items can also be exported, but subject to conditions indicated in ITCHS. Comet we have already discussed in our previous class in detail. So you must be aware that what a comet is. Then certain other points regarding EOU, EHTP, STP and BTP scheme. First of which is leasing of capital goods. Now, leasing of capital goods is an EOU, EHTP, STP or BTP unit may source capital goods from a domestic or foreign leasing company without payment of excise or custom duty on the basis of a firm contract between the parties. So if they are having a firm contract, then they can procure it. Then inter-unit transfer, the transfer from an EOU unit, or I would say, instead of repeating EOU, EHTP, STP again, unit, I would say, from one unit to another unit, if you are transferring the goods, supplying code, the unit which is transferred between EOU to EOU, so it is an import. It shall be treated as by second unit. Okay. Then sale of unutilized material. Now, we have procured some material, but that is for EOU purposes, for production or for provision of services. We have procured certain material, maybe within India or from outside India. But now that material has not been fully utilized. So how can we dispose of that unutilized material? What is the provision for that? Because EOUs are generally supposed to export all their production, but that material has remained unutilized. So how that can be disposed of? That can be either transferred to another EOU or an EHTP, BTP unit. If they require it, it can be transferred to SEZ unit also, or it can be disposed of in DTA. For that, the permission is required. You have to take the permission from the custom authorities for the same. And such transfer from EOU unit to another EOU unit would be treated as import for the receiving unit. Same case of inter-unit transfer. If you are transferring the unutilized material also between them, then that will be treated as import. For the receiving unit, for the buying unit, it will be import. Then export through other exporters. Now, EOU unit is also permitted to export goods through another exporter or another EOU, EHTP, STP unit, subject to specified conditions. Okay. Next one is exit from EOU scheme. Now, if a unit wishes to opt out of the scheme, if an EOU wishes to opt out of scheme, then it is allowed to that scheme. But what it has to do is, if this exit shall be subject to payment of excise and custom duties and the industrial policy which is in force at that time. And in case the unit has not achieved the obligation, which it has to achieve for EOU purpose, for being an EOU, but whatever obligation it has to achieve, it has not achieved that obligation in case, then it shall be liable to a penalty also at the time of exit from EOU. Then it is also possible to get converted from, or conversion of an DTA unit into EOU. An existing DTA unit can also get converted into an EOU or EHTP, STP unit. So that is also, it has to apply for the same, and it can get converted into an EOU, EHTP, that is allowed. In such cases, unit will remain in bond and avail exemptions in duties and taxes as applicable. Now, so the main concept of EOU is that entire production has to be exported. But as I told you earlier, that certain specified DTA sales are permissible. In certain cases, it can sell the goods in DTA also, or it can provide the services in DTA also, that is permissible. Now, what is that case? Whenever a EOU unit has to sell certain goods in DTA, first of all, the first condition which needs to be fulfilled, and that is the primary condition, and which is fulfillment of positive NFE. It should have a positive NFE. In fact, every EOU unit needs to have a positive NFE, but in case it wishes to sell certain goods in DTA, that is the first condition, that it should have a positive NFE. Otherwise, it is not allowed to sell any goods in DTA. Positive NFE, we know that export FOB value of exports should be more than CIF value of imports. Then the second condition is that it can sell the units, it can sell the goods into DTA up to only 50% of the FOB value of exports. So its total exports which it has made, out of which only 50%, the 50% of the FOB value, it can sell in DTA, to DTA units, and that too will be subject to payment of duties. Okay, whenever you make a sale, EOU unit makes a sale in DTA, it will be subject to duty, but those duties will be concessional duties. Otherwise, if it has to make the payment on full duties, then after that, after 50% of the FOB value of exports, it can make the sale in DTA on payment of full duties, but concessional duty payment will be allowed till 50% of the FOB value of exports. Now, what this concessional duty is, or how can we compute this concessional duty, this we'll elaborate later on. If time permits, then I will take that how you can compute this concessional duty. In fact, in our study material, it has been covered in chapter 4 when explaining the concept of SINVAT. We have explained you that how you can compute the this concessional duty and how you can claim the SINVAT credit, which part you can claim as SINVAT credit also, that has been explained. But if time permits, then I will take it here today. One more point here, in case the unit is manufacturing and exporting more than one product, then sale of any of these products into DTA up to 90% of the FOB value of these specific products is permitted. That means if it is manufacturing 2-3 products, then any of the products can be 90% of the total sales which it is making in DTA. Okay. But the total of these sales, that means total DTA sales should still be limited to 50%. But out of this 50%, since 2-3 products are there, so one of the products can be 90% and other products can be lesser of the lesser percentage. So it is not so that all 3 or all 4 have to be equally distributed among this 50%, but the overall sale in DTA will be limited to 50%. Okay, so DTA sales are allowed, but only 50% of the FOB value of exports. Similarly, services can also be provided in DTA up to 50% of the value of exports. Same condition is there for provision of services in DTA. That is, same limit is applicable to provision of services in DTA by EOU. That is 50% of FOB value of exports or 50% of exchange earned, as the case may be, where payment of such services is received in foreign exchange. Now, this is for this particular condition, that where payment of such services is received in foreign exchange, that 50% of the foreign exchange or 50% of the FOB value of exports, as the case may be. Then this is the computation of duty, but we'll take it later on if time permits us to take this. Next is the concept of deemed exports. Okay. Now, first of all, what is export? Export is taking goods out of the country. So when I say deemed exports, it is very obvious that these exports are not exports in the normal sense, or as such they are not exports, but they have been deemed to be exports. That means in such a case, the goods do not leave the country, because if they have left the country, they would have been exports in the normal sense. So they do not leave the country, but in order to give these transactions, such transactions, the benefit of export, they have been termed as deemed exports. Let us now understand the reason for introducing this concept. Whenever instead of importing an input or capital good from outside India, an exporter procures it from a domestic supplier, then a considerable amount of foreign exchange is saved. In case of the deemed exports, the first and the foremost reason for promoting deemed exports is this, that foreign exchange is saved. How it is saved? Because when we import the goods, although duty on such inputs or capital goods are exempted, but consideration for them is to be paid to the foreign supplier, and that consideration is in foreign exchange. So that leads to outflow of foreign exchange. Now, this foreign exchange outflow can be prevented by procuring goods from the domestic suppliers. But these domestic suppliers need to be given some hand holding for making them competitive, because otherwise if we take them at par with the foreign suppliers, then it will be very difficult for them to compete with the foreign suppliers. So this hand holding is actually the deemed export benefits which we give to them. We consider their supply to the exporters as, deem them as exports, and then we provide them deemed export benefits. What deemed export benefits they get, this we'll discuss later on. In fact, if you remember, while explaining the previous export promotion schemes, in all these schemes we have discussed that whenever an exporter procures goods domestically, either it's imports under DFIA, advance authorization, EPCG, and then in EOU also we have discussed that DTA suppliers will be entitled to the deemed export benefit. At that point in time, you might not be able to appreciate this well, but now you will be able to understand it properly, and you will appreciate that what deemed export means. So with this objective, the concept of deemed exports was introduced. The objective of deemed export is to ensure that domestic suppliers are not in disadvantageous position vis-a-vis foreign suppliers. Okay, and in fact, the main reason is that foreign exchange is saved. The main temptation for this the main reason for giving this benefit is that a lot of foreign exchange is being saved when we procure the goods domestically from domestic suppliers. Now, what are deemed exports? What type of supplies do we consider as deemed exports? First one is supply of goods against advance authorization. Now, in case a domestic supplier has supplied goods to an advance authorization or advance authorization for annual requirement or DIFI holder, if any person who is holding this authorization, and if a domestic supplier has made any supply of goods to this particular person, then that will be considered as deemed export. Then similarly, the second one is, now these type of deemed exports are supplies in case of manufacturer. These supplies are whenever a person who is a domestic manufacturer, who is a DTA manufacturer, he is manufacturing goods and he is supplying these goods. First was advance authorization or DFIA holder. Second is if a domestic supplier has supplied goods to a unit located in EOU, STP, BTP or EHTP, he will also be entitled for deemed export benefit. In fact, just now we have covered EOU, STP scheme, and there also I told you that any domestic manufacturer who has supplied goods to these units, then he will be entitled to the benefit of deemed export. Okay. Now, here one important point is that whenever we supply goods to EOU, STP, BTP, HTP, that is considered as deemed exports. But along with these terms, along with these units, you know that there is another scheme, that is SEZ, Special Economic Zone, that we'll also discuss later on in detail. But whenever a manufacturer makes supplies to SEZ, then that is not a deemed export. In fact, that is export in itself, because SEZ we consider as a separate island or separate area. If we consider this area to be outside India, although Physically, it is there very well it is very well there in India, but we consider it to be a unit or to be a area, to be a place outside India. So that is considered as exports. That is not a deemed exports. That is why you will not find SEZ in this list. Supplies to SEZ will not be considered as deemed exports. They will be considered as exports. Similarly, if a domestic manufacturer is supplying any capital goods against to a person who is having an EPCG authorization. So if any capital goods are supplied to a EPCG authorization holder, then that will be considered as deemed exports. Last is supply of marine freight containers by 100% EOU provided said containers are exported within 6 months. Now what does that mean? Marine containers, actually most of the exports are done in containers. We pack the goods in small packages and then we load all these packages in the containers. One container can contain the packages of different exporters also, depending on their quantity of export. So when all the export goods are packed or loaded in a container, after that these containers are loaded in the ship for export to other countries. Now if these marine freight containers, which I just discussed, if they are supplied, they are manufactured in India and supplied in India by 100% EOU, then these are treated as deemed exports. So supply of a marine freight container by 100% EOU is deemed exports. But the condition attached to this supply is that these containers should ultimately be exported. But ultimately these containers should be exported, and that too within 6 months time. Okay, so this supply will also qualify as deemed exports. And all these supplies need to be made by the manufacturer. Then what other supplies qualify for deemed exports? Now these are the supplies which we are going to cover in this slide, can be made by main contractor or by subcontractor. There are certain projects which are financed by World Bank or international finance organizations. In such cases, there is international competitive bidding which is held. Now, supply of goods to such projects or turnkey contracts under international competitive bidding will also qualify for deemed exports. So if we have supplied any goods to these projects, to projects where which are financed by the World Bank or international finance organizations, wherein the international competitive bidding is held, that will qualify for as deemed exports. Similarly, if we have supplied the goods to mega power projects, again against international competitive bidding, that will also qualify as deemed exports. Any goods which are supplied to United Nations or international organizations, then that will also be deemed exports. And supply of goods to nuclear projects. Now, in case of nuclear projects, there is a difference. In first two supplies which we have covered here is international competitive bidding should be there. These projects should be under international competitive bidding. But in case of nuclear projects, the supply of goods to nuclear projects should be against competitive bidding. So it need not be an international competitive bidding. Any type of competitive bidding will be included here. So this covers the supplies which will be considered as deemed exports. First, we considered the supplies made by the manufacturer, which will be considered as deemed exports. And secondly, we covered in this slide, we covered the supplies made by the main contractor or the subcontractor to the specifically designated projects under international competitive bidding. And in case of the nuclear projects where international competitive bidding, international is not required. Competitive bidding need not be international. It can be national also, domestic competitive bidding also. Now we come to the benefits of deemed exports. So we had already told that when you will make these type of supplies, you will get the deemed export benefits. Domestic manufacturer, domestic supplier of services will get the domestic manufacturer will get these type of benefits. So now what are the benefits which you will actually get? So now we come to the benefits for deemed exports. First is refund of terminal excise duty if exemption is not available or vice versa. Now what does it mean? First of all, you should know that the benefit of deemed exports, they vary depending upon the type of supplies made by the manufacturer. Okay. In each type of supplies made, there is a different type of the deemed export benefit which is available. In some cases of deemed export, there is the domestic manufacturer is eligible for outright exemption from excise duty. Okay, whatever product he has finally supplied to the exporter, and that product is eligible for excise duty exemption. So in case the product which he is finally supplying to the exporter is eligible for exemption from excise duty, then in that case, now this is actually a benefit, so he need not get so he will not be eligible for refund. He has got the exemption straight away. In this case, there is a special point that if he is eligible for exemption of what is terminal, here we have used a term terminal excise duty. I will explain you what is terminal excise duty. So if he is eligible for exemption of the terminal excise duty on the final product which he has supplied to the exporter, then he has to claim that exemption. He cannot pay the duty and later claim the refund. He will not be eligible for refund. That is what we say, that refund of terminal excise duty if exemption is not available. But in case exemption is available, you claim the exemption, and that is the benefit, that is the deemed export benefit you are getting. But in case this exemption is not available, then the refund of terminal excise duty which you have paid on the final product supplied to exporter, that will be available. Now, what is terminal excise duty? Terminal excise duty is the duty which is actually paid on the final product. So whatever final product you are supplying to the exporter, domestic manufacturer, the final product which it is supplying to the exporter, that is the terminal excise duty. So either it is exempted, or if it is not exempted, then you will get the refund of such excise duty. Second benefit which is available under deemed exports is the deemed duty drawback. In case of actual exports, duty drawback is granted, but in case of deemed exports, we call it deemed duty drawback. Okay. Third benefit is advance authorization, or advance authorization for annual requirement, or DFIA. Now, in case where the manufacturer is supplying goods to advance authorization holder or DFIA holder, then he will get the advance authorization or DFIA benefit for the supply of the intermediate products which he is supplying. So with this, we come to the end of the deemed exports. Okay, so we have covered two concepts today. The concept of UU, EHTP, ESTP, and BTP. And then the second one is the deemed exports. Now the third one is the So now the third concept is special economic zone, but before that, we'll take some of the queries which have come.
Aditya is asking, what is terminal excise duty? I hope your question has already been answered by Shefali. It is the duty which is payable on the final product. And can EOU import restricted items? That was already covered in the slide. Yes, EOU can. Now we can move to the PPTs. We can start with SEZs now.
In fact, before taking SEZ, let us first of all discuss the problem, the computational problem, which I told you that if time permits, I will take you to the computation method of duty in case of the DTA sale. Now we know that the EOU units can sell goods in DTA, but at concessional duties, they are getting this benefit that they need to pay lesser amount of duty when they sell the goods to DTA. Now, how to compute that? Okay, now this is important from SINVAT point of view also. Let us start it. Now, we are taking the assessable. We are starting the question from the assessable value. Suppose the UU unit has sold the goods to a DTA unit worth rupees 20 lakhs. Okay, the assessable value is 20 lakhs. Now, basic custom duty. The rate of basic custom duty was actually 10%. 10% of basic custom duty was leviable on these products which it has sold to DTA. But in case, since it is an EOU unit and it has the facility of selling these goods at concessional rate, so it will be having 50% exemption. Now, actually, this computation of duty from EOU to DTA sale is primarily guided by notification number 23 by 2003. Notification number 23 by 2003. Okay, so in fact, I will tell you the entire, the complete notification number. 23 by 2003 dated 31st March 2003. If you wish to go back and refer the notification also. So this notification provides that basic custom duty up to 50% will be exempt in case of EOU goods sold by EOU to DTA. So effective rate of basic custom duty will come to 5%. On 20 lakh rupees, the duty amount will be rupees 1 lakh. So this is basic custom duty. Next comes CVD. The rate of CVD, you know that at present the standard, the general rate of excise duty is 12.5%. So in this case also we have taken 12.5% as CVD rate. ECHSEC has already been subsumed in it. So this is in fact earlier also the EC and HSEC were exempt, but now they have been subsumed in CVD rate, the excise duty rate itself. So at 12.5% you will compute CVD, which comes out to 2,62,500. For CVD, what value we are taking is assessable value plus BCD. So on this we'll compute CVD, that is 21 lakhs into 12.5%, and that comes out to be 2,62,500. After that we have to levy the education cesses of customs. If you are attempting a normal question, if you are computing in normal case, if you compute the customs duty, then also you know that special CVD, education cess is never levied on special CVD. So similar is the case with EOU also, that special CVD will not be computed on EC and HSEC of customs, and therefore you have to levy EC and HSEC before levying special CVD. The rate of EC, that is education cess, is 2%, and that will be computed, this 7250 is the amount. Now how it is computed, this 2% you will take on 1 lakh plus 2,62,500, that comes out to 3,62,500, and 2% of it will come to 7,250,000. Similarly, SHEC, that is secondary and higher education cess, will be 1% of 1 lakh plus 2,62,500, that is 362,500, that is 3,625. Now we come to the computation of special CVD. Now this notification prescribes one important point, that special CVD in case of EOU sale to DTA will be applicable only when state VAT is not payable on such goods. If in case of sale of such goods if in case the state VAT is leviable on such goods, then the special CVD will be exempt or special CVD will not be levied. However, if state VAT is payable, then the special CVD will not be payable. If state VAT is not payable, then special CVD will be payable. So in this case, since the state VAT we have taken to be nil, we have told you in fact here that if state VAT is paid, it will be nil. But in this case, we have assumed that state VAT is not payable. That is why we have levied the special CVD at the rate of 4%. We have assumed, or you can say this is the case where we have taken that state VAT is not payable. So since state VAT is not payable, special CVD is payable. Had state VAT been payable, then special CVD would not have been payable. So this thing you should be very clear, because this is something which is a bit different from the normal customs duty computation. Okay, so you will take 4% of the assessable value plus BCD plus CVD and plus both the cesses, education cess and secondary and higher education cess, and then you will get the 4% of it will be 94,935. And then total excise duty payable. Now, why we said this, that this is excise duty payable? This is not the customs duty. This is only the, we have taken the customs duty, but actually the duty which we are paying is the excise duty, because we are selling it in India. These goods are being sold in India. So this is not an export. Only for value computation, we are taking the customs duty, but this is the total excise duty payable. So this excise duty payable will come out to be the basic custom duty, that is 50% basic custom duty plus CVD plus both the cesses and the special CVD. And the amount comes out to be 4,68,310 rupees. Okay. So this is how we'll compute the duty in case we remove the goods from UU to DTA.
Now let us move to special economic. In fact, if you remember the last session also, I told you that special economic zone is not a part of the policy per se. It is not covered in the foreign trade policy because it is governed by a separate act. Special Economic Zones Act 2005, it is a special and specific act which governs the provisions relating to special economic zone. However, it is important to read it along with foreign trade policy because special economic zone is also specifically it is being created, it is being set up to promote exports. It is also one of the export promotional measure adopted by the government. So we study it along with the foreign trade policy. However, the provisions of special economic zone, they are covered in the Act Foreign Trade, Special Economic Zones Act 2005. So now let us try to understand what is special economic zone. Special economic zone is a specifically delineated duty-free enclave, and it is deemed to be a foreign territory within India for the purpose of trade operations and duties and taxes. You can say that SEZ is a separate island within a country or a geographically bound region where the economical laws relating to import and export are more liberal and broad-minded as compared to the rest part of the country. SEZs have been established in several countries like China, Russia, Portugal, etc. In India, the concept of special economic zone first came into being on April 1, 2000 with an objective to enhance foreign investment and provide an internationally competitive and hassle-free environment for the exports. Till 2007, Customs Act had provisions for special economic zone in Chapter 10A. Customs Act used to provide for the provisions relating to special economic zone. However, with the promulgation of the new specific Special Economic Zone Act, the said chapter was omitted from the Customs Act. The preamble of the Special Economic Zone Act, it provides that the SEZs are set up for development and management of the Special Economic Zone Act is for the development and management of the SEZs, for the promotion of exports and for the matters connected therewith. In simple words, the basic purpose is to provide a smooth and hassle-free operations in SEZ and a single window clearance for setting up an SEZ or a unit in SEZ. That is what basically the Special Economic Zone Act tries to achieve. SEZ Act has overriding effect. This is a very important point. It has overriding effect. That is, the provisions of SEZ Act will apply notwithstanding anything inconsistent contained in any other law or any other instrument having force of law. So for what purpose can be set up a special economic zone? They can be set up either for manufacture, if the one wants to manufacture and export something, or even if one wants to render services, or also for trading. For all these three purposes, the special economic zone can be, a unit can be set up in the special economic zone. Then special economic zone units, they are exempt from all taxes like customs duty, excise duty, central sales tax, state VAT, income tax, service tax, etc. In fact, you remember, you may know that notification number 12/2003 ST, it exempts services received by a unit located in special economic zone or a developer of special economic zone if they are used for the authorized operations. So that's how, in fact, these exemptions basically are respectively, they have been given effect to in the respective acts. Further, goods can also be brought in the special economic zone without payment of customs duty or excise duty. When a special economic zone procures goods, it can bring those goods without payment of customs duty or excise duty. One particular aspect or characteristic with which these special economic zones are most often related to is that when one supplies goods from DTA to SEZ, DTA, you know, is a domestic tariff area. When goods are supplied to SEZs from DTA, they are treated as export. In fact, Shefali just now told you that they are not deemed exports. They are exports. They are treated as exports from India. And when goods are supplied from the SEZ to the DTA, they are treated as imports into India. The reason is they are treated, in fact, just now I told you, they are treated as foreign territory within the India. For customs purposes, supplies to SEZ from manufacturers in DTA, as I told you, are treated as if they are outside India, that is, they are treated as exports. These supplies, in fact, are also considered for discharge of export performance of supplier. So if any supplier, if he has taken any authorization or any export promotion scheme under which he has to achieve certain amount of export obligation, so if he is supplying the goods to the SEZ, that supply will be counted towards his achievement of the export obligation or export performance, because as such the supplies made to SEZ are considered to be as exports. The DTA supplier supplying to SEZ will be entitled for export promotional benefits like drawback or DFIA. Goods supplied from the SEZ to the DTA are treated as import, and in that case, normal customs duty is payable on such goods. Because in that case, if the goods are treated as imports into India, in that case, normal customs duty is payable on these goods by the person who is importing the goods. Now, goods manufactured in SEZ are not liable to excise duty. As you would have read in the charging section 3 of Central Excise Act, that specifically the goods which are manufactured in special economic zone, they are excluded from the purview of the charging section 3. Central excise duty is not leviable on those goods. So in other words, you can say that the goods which are produced in special economic zone are excluded excisable goods. They are not liable to excise duty at all. So this is the case when the SEZ is manufacturing goods, excise duty liability is not there at all. Now what happens when SEZ procures excisable goods from DTA? In that case also, excise duty is exempt. That is, supplies made to SEZ by Indian manufacturer are exempt from excise duty. So if you see carefully, benefits are also given to the suppliers who are supplying goods to the SEZ. Then SEZ, in fact, as I told you earlier, it enjoys hosts of tax exemptions. They are also exempt from paying the central sales tax. So dealers in India who are supplying goods to unit, they in fact are also exempt under the CST Act, provided they furnish a declaration in the prescribed form. There's a form I which they have to furnish to Indian manufacturer. Then they would be exempt under the Central Sales Tax Act. With this, we are over with the special economic zones. Can we take some online queries?
First query asked by Honey is, can you give summary type lecture for FTP and highlight amended parts? First of all, we told you that it is an overview of FTP. So summary, once you are through with the detailed portion. Summary you can prepare yourself. And second is highlight amended part. In fact, it's a new policy which was introduced last year on 1st April 2015. This policy was introduced, Foreign Trade Policy 2015-2020. So entire policy has been replaced. It's a new policy. So highlighting amended part will not be possible. This policy in itself is a new policy. So everything is as per the new policy, policy 2015-2020.
In fact, I would say that this lecture also is a kind of summary. There is, if you go and refer to the study material, there are much more things which we need to cover. In this lecture, we try to summarize the things and present it to you.
Now, next question is, who is the authority to grant status of UU? Asked by Samar Juneja. As I discussed in the UU session itself, that UU, basically two types of approvals are there. There are certain conditions which need to be fulfilled. If those conditions are fulfilled, then you get an automatic approval which is granted by Unit Approval Committee. Okay. But in these conditions are prescribed in the procedure part. You know, handbook of procedures, that is prescribed there, but that is not relevant for you because that will turn to going too much into detail. That is not required. And if those conditions, those prescribed conditions, you should know certain prescribed conditions are there. If you, for knowledge purpose, you can see the procedure part if you want to see. And if those conditions are not fulfilled, then it will go to Board of Approvals, and Board of Approval will grant the approval to set up an UU export oriented unit. Aditya has asked, is CVD rate on any kind of goods sold in DTA is 4%. Does it changes according to category of goods? CVD, if you are asking, CVD, you know that is a duty which is imposed at the rate at which it is imposed on like articles manufactured in India. So if any articles, any goods in India which are manufactured in India, they are subject to a excise duty rate of 4%, which is a concessional rate. If any goods are subjected to that rate, then corresponding CVD rates will also be 4%. But it changes with category. But general excise duty rate is 12.5%. So in case in question, nothing is given to you for examination purposes. If nothing is given to you, then you should assume the general rate only. If it is mentioned that similar type of goods are manufactured in India, so you will take the general rate. But if question specifically states any other rate of excise duty, then you have to take that rate of excise duty. CVD is the rate of excise duty which is leviable on the like products manufactured in India.
But I would like to add to it. You're asking a CVD rate on any kind of goods sold in DTA. See, if you are selling goods in DTA, then there is no question of CVD. Only when you import goods, then CVD comes into picture. Or if you are making a sale to SEZ when it is being considered as export, in that case, export or import, in that case, CVD comes into picture. If it is a mere case of sale in DTA, a DTA supplier selling to another DTA supplier, then there is no question of CVD. Only when you import, then that CVD comes into picture. I think we don't have any more queries now. So we come to the end of this session, and we hope that you have been able to understand at least some of the aspects or concepts of foreign trade policy. In case if you have any doubts or any queries, you can write to us at smita@ica.in or shefali.jain@ica.in. We'll be happy to help you. Thank you.
Thank you.